Good afternoon, good morning, everybody. Thank you for joining us for the March edition of our WASDE recap. As Greg said, pretty quiet event again, really back-to-back months where the USDA has made very minimal changes to both the world numbers and the US domestic numbers. So with that being said, we will go ahead and jump right in, beginning with corn as always. One more, Greg. Greg's controlling the slides here today. So yeah, so starting with corn on the US side of things, I will briefly say, just to lead things off as we speak, corn futures up about $0.015, slightly off of their daily highs. So I think, as we'll talk about, traders were maybe expecting a little more bullish flavor to the report than we ended up getting today. As you can see, ignore the Jan and Feb across the top there. I neglected to change that by mistake, but that's actually Feb and March, and it really didn't make a difference because, as you can see, the USDA didn't change anything yet again, back-to-back months here, leaving the US balance sheet completely unchanged on corn. So going down, where traders were maybe expecting to see some change here was on the demand side. Obviously, specifically to the export side was where I was really singling in on, thinking we might see some acknowledgement from the USDA, just given the very strong pace to export demand for corn thus far through the marketing year, now about just over halfway through the marketing year, but decided to kick that can down the road yet another month here. So the bottom line is still just over 1.5 billion bushels of corn carryout. They left our projected farm price unchanged as well. So Greg, if you want to jump to the next slide. Jump into the world numbers here. A few changes here. Nothing really out of the too far away from what traders were maybe expecting. The ending stock number, as you can see on the right there, did get just not quite a 2 million metric ton cut to world ending stocks. The notable feature is, though, that if you don't include China in that number, we actually increased ending stocks for the world corn balance sheet slightly. I mean, not by much, as you can see, a fraction of a million metric tons. So overall, that cut was primarily to do with, again, China's import expectations being dropped as compared to the last previous couple WASDEs. They keep trimming away their export numbers here, another 2 million metric tons out of that metric here in the March report this morning. Otherwise, notably, traders are always interested this time of year to see what they do with South America. The red box on the left there, you can see I've singled out Argentina and Brazil. Brazil, I'm not too surprised to see the USDA leave that alone for now. That crop, they did cut that by 1 million metric ton last month, and that crop, obviously, the majority of it just getting planted and just getting started in its vegetative stage. The weather in April and May will really be what makes or breaks that safrinha corn crop for Brazil. Argentina, on the other hand, I was a little surprised to not see a cut out of their 50 million metric ton estimate. That was cut in February as well, after that very hot and dry January through much of Argentina's grain belt. I expected to see more of a cut this month on that, just due to, a big chunk of that crop pollinated through that hot, dry stretch in the middle of January. The later pollinating and later maturing corn was probably fine, as the rains were vastly improved through February. But obviously, the USDA is wanting to wait and maybe see some more harvest activity before they decide what to do going forward. So I'm still not convinced of that number, but for now anyway, it'll be what trades. It's what the USDA is calling it, at least for this month. And then lastly, I did want to also note that the USDA is starting to show some demand destruction out of Brazil. As estimated coming into this report, Brazil was showing their lowest ending stocks for corn since about 2001. So it was getting to the point where you really had to start thinking they weren't going to be able to either, they have a big feeding program, obviously, as you can see, about 64.5 million metric tons, and you see they're taking bushels out of their export expectations and shifting some of it into feed, but really just saying that there's not going to be the corn available even with a very strong production to keep that export number as high as they had it. So something to keep an eye on there, but definitely something that I construe as bullish towards U.S. corn to have less competitors essentially in the world marketplace. We can move on to the next, Greg. Looking at the world corn ending stocks, excuse me, excluding China. Again, always like to exclude China just given the closed nature of their system. As of this morning, the USDA estimating just under 3.5 billion bushels of global corn ending stocks. It's still, as it has been the last few WASDE reports, still the least since 2012-13. As you can see, it's been on pretty much a steady decline since the 2018, 2019 years. So, definitely a bullish point currently. As mentioned, this number did remain relatively static month over month, but overall still a tighter amount of corn left over in the world forecasted for this crop year. We can go on to the next, Greg. Going into the demand columns kind of one by one here, we'll start with corn exports. Again, this is where I expected to maybe see some improvement from the USDA, just given the strong pace. As of February 27th, the most recent corn export sales report last Thursday, we're sitting with just under 2 billion bushels worth of commitment. So that's between just over a billion bushels of shipments and about 856 million bushels of sales. All total, this commitment pace is running about 26% above the previous marketing year. And as you can see by the chart, basically what I put out here is we have our 5-year moving average. Our current year is the green line, and then I wanted to compare to obviously the analog year. The record export year is 2020, 2021. And as you can see, thus far through the marketing year, we're pretty much neck and neck with that record year. The next few months are going to be what really either separates this year or, we'll chalk it up to slightly less than the record year if we can't. You can obviously see with that dotted red line, it really took off to another stratosphere during March to May, where you'd expect your weekly corn shipments to reach their peak. So export inspections yesterday were a marketing year high and actually above every one of the previous 5 marketing years for their respective weeks. So even up until yesterday, the pace is very impressive and very strong. As you can see, the current USDA estimate is only a 7% increase year over year. So was a little surprised to not get anything out of this bucket here today. I'm not ruling it out for subsequent reports, but for now, the USDA playing it very cautious, probably wanting to see what Brazil has available for corn before getting or how our shipments look through that all important March through May period before getting too carried away with their estimate. Greg? Jump into corn usage for ethanol, also a strong thing. I didn't really expect to see any acknowledgement out of this time around, just because the pace we're running above is stronger than what the USDA is estimating. As you can see, we're about 2% above 2023-24 versus a 0.5 point increase expected from the USDA. So maybe not a large enough gap there to warrant too much of an increase given the stout corn usage they're already using at 5.5 billion bushels. But it is something to keep an eye on, especially as we move into the summer months, where we'll see our obviously highest driving demand, typically your highest blend rates, and also with the recent ruling that it's going to allow E15 in a select amount of Midwest states for summer usage is also a bullish thing in terms of corn being used for ethanol through the summer. As you can see, the dark dotted line. Oh, could you go back for a second, Greg? sorry about that. The dark dotted line is just a projection out of maybe what to expect for this moving forward. I will say my personal number, just given the seasonality, is slightly less than what the USDA is using, but by no means am I saying that's an absolute truth or anything. Just gives an idea of what maybe to expect here into the summer months, just given the typical seasonality of corn used for ethanol. Looking at corn basis, as you can see, still an uncharacteristically weak basis given the stocks and the demand we're seeing. But as you can see, it is rapidly improving over the last couple of weeks, mainly to do with the sharp drop in futures price. Basis tends to be a little more resilient than futures prices, especially when you have a very strong demand scenario like we do. So it's currently right around 36 cents under the May board. That's about not quite a dime, 9 to 10 cents improved since the end part of February on a national basis. As you can see, there was a sharp drop there as we rolled from the March to May, which rolled at a pretty impressive carry considering how it had been most of the contract life. It really broke out towards the end of the contract life for March. But as you can see, it's been steadily earning back that cash carry. Like I said, about 9 to 10 cents a cash carry put into the market just through the basis in the past 2 weeks. So overall, though, still an uncharacteristically weak basis compared to what you'd expect given the amount of demand. We're about tied for the fourth weakest in the past 10 years, and we're about 19 cents currently weaker than last year, which is an interesting thing. So it'll be interesting to see through the balance of the spring here, once we, producers get into the fields, less corn's moving in the countryside. If we maybe see this this basis continue to appreciate, kind of like the 5-year average and last year, the blue and green lines, steady improvement pretty much up until the roll out of the May to the July board. Great. Looking to the non-commercial corn trader position, this is obviously had a lot to do with the huge drop of upwards of 60-ish cents on the May futures. As you can see, since reaching its peak in the middle part of February, non-commercial traders as of last Tuesday had liquidated roughly a quarter of that length. So they were still sitting north of 300,000 contracts, 335,000 contracts long as of last Tuesday. And we've been up, if we stay up today, we'll be up, 5 sessions since then. So you got to assume that they've become buyers again this week at these, obviously when we dipped below 450 for a minute on the May, corn board, that spurred a lot of buying interest from non-commercial traders. So I expect this report on Friday, if we stay trending how we are, which it'll be as of today, is probably going to show some more length than that 335,000 contracts. But it is worth keeping an eye on, as we know. They liquidated about 100,000 contracts and sent the price down about 60 cents. So if these traders, continue to remain skittish and see a reason to exit these long positions and exit them rapidly, there's definitely damage they can do to the price, as we've seen in the process. For now, at least the fundamentals, I think, are keeping most of them in the game. They're seeing enough bullish points, I think, from the supply and demand numbers to want to remain at least somewhat long. Probably we're just getting a little uneasy with how close they were getting to that green line, that record long. So something to keep an eye on. Like I said, expect them to be building more length here in that report this Friday. Jumping into soybeans now, starting with the U.S. balance sheet. Again, similar to corn, no changes by the USDA this time around. Kept the demand unchanged. This was probably construed more as bullish for soybeans, as I think there was some nervousness coming into this report that perhaps we'd see a reduction in export demand for soybeans, just given how much that pace has slumped in the first couple months of 2025 thus far. But as you can see, decided to kick that down the road as well. Again, probably likely waiting to see how Brazil's export program shapes out. Their crop, obviously, at this point, going to be more or less made. But their export, coming into new crop, their exports are kind of lagging a touch just because the Chinese demand isn't there in the way it has been in years past. So the U.S. probably, or the USDA probably wanting to wait to see how that shapes out before getting too carried away on reducing U.S. soy demand. And the flip side of that is, as we'll talk about, U.S. crush demand is predicted still at a record just over 2.4 billion bushels. That could be, kind of a wash here moving forward between if they take out of exports, might be seeing some gains on the crush side of things. Looking at looking at the world soybean bauxite, excuse me. As you can see, again, another decent cut out of the world ending stocks, about 3 million metric tons. Again, in this month, that all total brings since the December WASDE, we're over 10 million metric tons now less on world soy stocks than we started 2025 with. So that's as a result of a number of things, but primarily, reductions out of Argentina last month took a big bite out of that. And then also they keep penciling in higher demand in the world as well this time around. And this month it was, a higher expectation of soy crush, primarily coming out of China, but also a little bit out of Argentina as well, which may be construed, as you can see in that middle box, the 42 million metric tons of Argentine crush might be construed as somewhat bearish to the meal market and to the oil market, as Argentina is the leading exporter in the world of those two soy products. So something to keep an eye on there. Otherwise, as you can see, the USDA left South American production alone. Again, this is probably fairly neutral. I think the market was maybe expecting more cuts out of Argentina. I personally was a little iffy on that just because of the amount they took out in February. Dropping that estimate by 3 million metric tons in one report, I thought last week was a pretty strong drop in one go. And then obviously Brazil, there are some issues in the south of Brazil in their late maturing full season soybeans that maybe will eat into that a little bit, but the yield expectations or performance thus far in central Brazil has been steady to even above expectations, especially in Mato Grosso, which is the country's leading producing state. So the idea there is that any reductions in southern Brazil may be seen with an offset in northern or central Brazil. Just putting Argentine and Brazilian soy production into perspective here, as estimated this morning, still stands just above 8 billion bushels, still a record between the two countries. Again, primarily Brazil driving this. They make up, 3/4 of that number. And all total is, as estimated, it's going to account for 52% of the total production in the world. So within the next month or so, as we get the majority of these soybeans harvested, we're pretty much going to know what our world market looks like, because if you add the U.S. into that number, it jumps to 80% of the world's beans that are ready and in the market at this point. So barring a late season, like I said, maybe the southern Brazil thing has a bullish story there, but outside of that, probably what we have at this point in March is what we're going to get in terms of world soybean production, specifically in terms of South American production. Looking at world soybean stocks, China, not including China, still the second largest on record at 77.45 million metric tons. That was a slight reduction. That should say February. I apologize for that. It is a reduction from January as well. They've reduced it 2 months in a row, but down slightly. It was a fraction of a million metric ton from January. Interestingly, China's stocks also drawn down 2 million metric tons as a result of more crush demand domestically in China. So as a result, still looking at, if you add those together, it would send that red line all the way up to the top of our graph at 120 million metric ton world carryout for all countries included. That's a record, including China. Not including China, we're at the second highest level ever. And if we keep cutting it like we have been, you're quickly going to be challenging the your 2018, 2017 levels before we obviously got the big spike in the 2018, 2019 season, primarily as a result of the first trade war between the U.S. and China. Soybean export pace, again, this is where I was a little nervous coming into the day. I was expecting the USDA might even give us a cut here, just given how much this pace has really led up since the beginning of 2025. As you can see, I've tried to mark in the arrows first on the left of where we've performed this year, but the right arrow, the downward arrow, is where you'd normally expect your soybean exports to begin waning as South American, Brazilian beans in particular become available to the market. This came about 2 months early here. And so the fear here, for me personally, is that you'll see that red line take another drop off more in line with that the downward red arrow, or the green shaded area. You can see your 2023, 2024 kind of took 2 drop-offs. It's theirs came way early. Obviously, as you can look back in October of 2023 was when their first kind of drop in pace took place, and then their second one took place when Brazilian beans came available in March. So my fear would be that the book this year managed to stay strong through the 2024 calendar year. But now with Brazil beans coming to the market, we might be in for another slowing of pace, which will really flatten that line out. But for now, we are 13% still above 2023, 2024 versus the USDA's 8% expected increase. But again, the next few months are going to tell us a lot about where this soybean export book is going to end up for this marketing year. Soybean crush continues to be kind of the shining star of the soybean complex. Just no other way to put it, just a very impressive pace thus far through the marketing season. We've included, through the months we have, concrete data from the USDA on through January. We've had 4 of the top 5 crush volume months in history, including setting 2 monthly records in December and October. So, all totaled, that puts us over 1 billion bushels already through January. That's up about 7% over year. The USDA is estimating a 5.5% increase year over year. So not a huge gap, but that is something to be bullish about. And as you can see by my black dotted line, I've attempted to just seasonally adjust what you could maybe expect that crush demand to look like through the balance of the marketing year. And as you can see, projected to remain steadily above the previous several marketing years overall. So really at this point, it's pretty much a foregone conclusion to me that we will set yet another crush record. It's just at this point a matter of how firm that is compared to what the USDA is currently projecting. Looking at soybean basis, kind of the same story as corn. The DTN's National Soybean Index implying a basis on a national level about 66 cents under the May board. But as you can see, it's been rapidly improving over the past several weeks, especially since that March to May futures roll. It's picked up about 13 cents of cash carry in that time. So as we stand, we're about 10 cents weaker than this time last year. Again, it's kind of interesting to see that, considering how strong the demand has been. It kind of makes me a little nervous when we get to these stocks reports here at the end of the month of what the USDA is going to find for grain stocks on hand, and if they, did they miss something out of production, or what's going on. Anytime I see a basis that's had a character like this, it kind of gets me asking questions. But for now, it is moving in a way you would expect, given the strong demand and lesser supply than we originally thought, which as you can see, its rate of pace versus the green average and the blue 2023 year, much more rapid improvement here through the early spring thus far. Would expect that to continue until it's probably picked up all of that carry in from there. As you can see, it tends to level out, especially once the export demand kind of dissipates through the balance of the marketing year. But the crush should be enough to at least keep it somewhat steady, and it's probably going to end up, I'd imagine, somewhere in the middle of this 10-year range, closer to that blue line, I would think, when all things are said and done. Lastly, jumping to wheat. Wheat was kind of the most explosive changes here today, and unfortunately more on the bearish side as we speak. May Kansas City wheat down about a nickel, Chicago wheat's down about 3 cents, and Minneapolis wheat's down about a nickel as well. So overall, not being taken super hard by the markets right now, but a little more bearish outlook than what I think most traders are expecting. I was telling Greg before we went live that if you would have made me guess which one of the balance sheets was the least exciting today, I probably would have said wheat. I didn't really think they'd change anything, let alone raise the carry out as much as they ended up doing. But basically, how they got there, they did raise our carry out by 25 million bushels up to 819 million bushels, again back over that 800 million bushel mark. They did this by increasing imports by 10 million bushels and decreasing exports by 15 million bushels. The import number is interesting to me, just given the most of those imports are going to come from Canada, and given the recent trade concerns there, I kind of wonder if this is maybe a last minute surge by U.S. buyers to get in and buy their needs before those tariffs potentially go back into place here at the beginning of April. So time will tell on that. I was a little surprised to see that, honestly, but I guess it makes sense when you think about it in that set of circumstances. Otherwise, the export number we'll talk about more in depth here in a few slides, but still was a little surprised to see this much cut given where we're at, but it's also can be justified, as we'll talk about here in a few slides. The world balance sheet, kind of the same story, a little more bearish than thought. The main bearish development in this is we did kind of like I thought we'd see in February. The USDA just waited a month to increase the production numbers out of Australia and Argentina for wheat. Argentina's number in particular is much more in line now with what the local government of Argentina is saying they produced for wheat this last winter / their summer. And then for Australia, the same thing. It's just a very impressive recovery in Australian wheat production this year, and likely softens the blow somewhat of Russia's stocks being at a low point here. They did jumping down to Russia, as you can see, increase those just slightly. Interestingly, by increasing their production from last year. I'm not sure how many would agree with that, but overall, less exports again I think for the third straight WASDE, they've cut that Russian export number by 500,000 metric ton. It's still above private analyst estimates. I know Sovicon is in the 42s on that number, so something to keep an eye on there. But overall, those improvements in Argentina and Australia, and especially Australia's, expected to export more wheat now, probably keeps the absence of Russia here through the balance of this marketing year, softens the blow towards wheat importers. who are expected, on that top line, expected to import less wheat anyway, but likely helps to soften that blow from the world's biggest wheat exporter in Russia being absent here for the balance of the marketing year. Looking at world wheat ending stocks, kind of a unique view here. It gets a lot of attention that world wheat stocks to use. In the last year, I think last year it was the lowest in like 17 years, and now it's the lowest in about 9 years since 2015, 2016. But when you really start looking at the numbers and you take out the closed systems, it gives you a much different view. So when you take, if you look at world wheat stocks versus domestic demand, but you take China and India out of the equation, so both of those countries are huge users of wheat, the two biggest users of wheat in the world, but they also grow a lot of wheat, and they don't really import a lot of wheat, and they don't really export a lot of wheat. So it's bushels there that aren't ever going to be available to the world if we get a shortage somewhere that impacts international trade. So essentially, looking at the stocks to use ratio, not including those countries, gives you a better idea of why wheat futures, given that a 9-year low in stocks, have really failed to capitalize or turn that into any kind of futures rally through the last a year or two, other than weather-driven rallies, of course. But as you can see, it cuts that down to 2021, 2022 as the most recent ending stocks that was tighter than the one we currently run. So it's really not that big of a historical issue when you start actually looking at, okay, where is the wheat available? Where are the big wheat importers? This would suggest that there's still plenty of wheat available in the world to fill those needs and fill those gaps in demand as we make our way here through the marketing year. Depending on how Russia shapes out with production this summer and how the U.S. does as well, we'll reshuffle these figures. But for now, don't really see it as a hugely dire situation in world wheat. The USDA today, as mentioned, did reduce our export estimate by about 15 million bushels. As of last Thursday, we had been running about 10% above 2023-24 on commitments. Our shipment and inspections pace is much stronger, about 19% above. But the USDA prior to today was running about 20% above. They're expecting a 20% increase year over year in wheat exports. As you can see, they've reduced this to make it more in line with what the pace is actually showing. As you can see, that red line pretty steady though. Still expect us to end up somewhere above last year's number, but maybe not as much as had originally been thought. Coming into 2020-25 events, specifically, we are running closer to a 23% lead over last year until the last couple of months. That's really fallen off there on the pace for wheat export sales. Lastly, looking at hard red wheat basis, the same kind of characteristics in this, just pretty much a vertical line there in hard red wheat basis. It's really rapidly picked up the roll from the March to the May. As of yesterday, we were right about 59 cents under the May board. I expect this from here will probably level out similar to what we saw, that blue line last year, maybe get some spikes in demand through the spring months if we catch any, export sales here with our, obviously the drop in wheat price has, if there was a silver lining, it's that it's made U.S. wheat one of the most affordable options for world wheat in the world. It'll be interesting to see if with today's adjustments to the Argentina and Australia crops, if we maybe start seeing some pressure there to those prices. But for now, the U.S. is in a better spot than they were in terms of export competitiveness. So maybe we see that translate to some basis spikes. But overall, expect this to level out from the drastic increase we've seen over the last few days as it works to pick up that cash carry from that March to May roll. So overall, just kind of my views. We've actually recently, in the last since we've been talking, slipped into negative territory on corn for the day. Probably some negative influence from wheat, but I still view today's numbers as neutral to maybe slightly bullish on corn. World's corn stocks are retracting again, but notably not including China. We are sitting with roughly the same amount of world corn stocks. And then the U.S. demand being unchanged may frustrate some corn bullish traders. I really was personally expecting some increase in demand there, but the fact that they pushed that off for at least another month perhaps will be seen as a bearish a development to some traders. But for now, I think it's mainly neutral, but maybe slightly bullish. Soybeans, I'm going to stick with neutral today. The balance sheet unchanged on the U.S. side. Analysts were expecting a possible increase, so that's probably a bullish development that we just kept everything static. World soybean stocks decline again, and the fact that we're now down over 10 million metric tons from December's estimate. Not yet a bullish scenario, but certainly sitting better than where we were in terms of the sheer volume of soybeans in the world compared to what we thought we'd be in December. And then lastly, on wheat, I am going with bearish here, larger than expected U.S. and world ending stocks, and then particularly where they got those stocks from, increases in Argentina and Australia, direct competitors in the world wheat market could hinder the progress the U.S. might have made. Again, given the sharp drop in our price, the larger available supply, plus the ocean freight advantage those countries have, could end up hindering the U.S.'s ability to be competitive on wheat exports here through the balance of the season. So other than that, the next WASDE is on April 10th to look forward to. And between then, we'll also have the quarterly stocks and prospective plannings reports here at the end of the month as well. So with that, we can jump into questions.
Well, Rhett, I don't see any questions, and I apologize if anybody's having difficulty with that using the chat function. This time we're a little bit different format than we're used to here. Oh, there's one that just came in. Question about tariffs. Rhett, not a big surprise that we might get a question about that. How do you feel about the updates today in terms of what's going to do to markets?
I guess I'm a little behind on the news today with the WASDE. Has there been an update from the government today?
Well, the last I heard, there was the increase on steel and aluminum to 50% from Canada. So we're getting pretty serious on the Canadian battle, and some noise out of Canada that they might not just raise the price of electricity to the United States, but might cut it off. So that might change the wheat export situation to Canada, I would bet.
Yeah, and I think we're probably, frankly, just due for another round of the same, fear, and as it directly pertains to agricultural markets, the same, fear-induced thing we saw at the end of February is probably just going to rinse and repeat itself as we get closer to that April deadline for the USMCA exemption to expire. I would think, at least on the Mexico side of things, seems to be, a reluctance there to announce any kind of retaliatory move. So maybe that's keeps the corn situation for U.S. corn a little more insulated to that compared to, the commodities directly influenced by trade with Canada. So, I would imagine that's probably your big part of, in conjunction with the WASDE, for why you have lean hogs, down pretty sharply here today and affecting the livestock markets a little more. But yeah, overall, I think I don't see that headline today, obviously, until there's actual news targeting an agricultural product. I don't really see anything immediately, but like I said, I do think we're probably just going to have a rinse and repeat here, unfortunately, at the end of the month as that next deadline comes near. And hopefully, both sides can get back to the negotiating table and figure something out to avoid a prolonged issue here. So.
A question I'd ask: last week we had our DTN Ag Summit series, and you and John Baranek talked a little bit about markets, and John was talking about the weather, and the forecast for especially the Western Corn Belt is dry and warmer than normal through probably May and June and maybe even into July. You mentioned the possibility of the real bullish news maybe being weather markets. I guess you're looking that there's a potential for a weather market rally this year, especially given the forecast that we're looking at.
Yeah, absolutely. And I think I also always just tie it back to the statistics. And the statistic I shared in that Egg Summit last Friday was that, since 1994 was when I ran the data back to it. It could be longer than this, but since 1994, in those 31 years, the December Corn Futures Board has never hit its calendar year high in February, and November Soybean Board has only done it once. So those odds still stay pretty much, solidly in the market's favor of setting higher, than the current highs for the calendar year, which were set in early February for both of those markets. So what's going to do that is likely some sort of weather event. I mean, it seems like, we get some sort of risk premium built into the market every year. That's just ultimately the function of the markets is to just dictate what that risk premium should be. So I am anticipating some kind of, April, May, June type of weather premium to be built into these markets. Whether that's, a quarter or 50 cents, we'll have to see of what the actual weather looks like. But yeah, as John had pointed out in that Egg Summit, it certainly doesn't paint so far a very pretty picture especially for the Western Corn Belt. Right now forecasted to be a pretty hot and dry spring, and then a continuation of that into at least June. So maybe we break out of that by pollination, but certainly right now I think there is reason to be concerned about potential issues in the weather, and then as a result, bullish of some sort of reflection of that in the markets.
Question on China, and the question is, why do you think China put the 100% tariff on Canadian canola oil and meal? Some thoughts on that?
Yeah, so I think that was a direct retaliation against Canada put a 100% tariff on electric vehicles from China back, and the timing of it is interesting because that was back in like October or November. That's been, almost 5 to 6 months ago that Canada put that in place. It was right around the time that China then hit them with an anti-dumping investigation. It was all kind of felt like a bit of a charade, but ultimately it was really interesting, the timing, because the trade data came out last week and showed that China had imported more crude canola oil from Canada in the month of January than all of 2024 combined, and not even close. It was by a wide margin, and it turns out that was definitely preemptive by the participants in China buying it up before those probably knew those were coming into place, those close to the government there. So for now, I think the market's maybe overblowing it a little bit. Right now, it doesn't cover seed, and canola seed is by far the largest export that Canada does to China. The crude canola oil is usually to the U.S. So I get the knee-jerk reaction, given everything that's going on with the U.S. I can understand why they were limit down yesterday, but overall, I still think, and our DTN Canadian grains analyst Mitch Miller made a good point of this yesterday, that there's not enough seed going to be left over currently to satisfy both the crush and export demand. So he kind of viewed it just as solving one of the issues. If they're not going to export, a bunch of oil, then they'll just export the seed, because the demand for that has been, pretty stout through the marketing year thus far, especially to China.
Yeah, and I'd note Mitch's piece on that is in the Canada Markets blog. that you can find on the dtnpf.com website. He goes into some of that a little bit more. A related question then on the canola oil tariffs and meal. Do you think that that will influence soy oil prices? Is it enough to spill over into the oil markets?
Yeah, it sure did yesterday anyway. Yeah, it's kind of an interesting relationship between the two. What raises one sometimes, for example, everyone, was thinking the tariffs against Canada from the U.S. perspective would bolster soy oil as less canola would be coming into the market. But for now, I view them, pretty much as complementary to each other. So while canola futures have been in this, obviously limit down yesterday, and they're down, another $14 per metric ton here this morning, and soy oil is down as well. So I think they're directly related right now. Just whenever a feedstock is, kind of landlocked, so to say, by a tariff or something, it just compete. It adds to the competitiveness, basically, just from soybean oil's perspective. It adds to the competitiveness that you could possibly see from a U.S. refiner's standpoint, of perhaps, barring any additional headaches of getting canola into the U.S. from Canada. You are seeing, as of the most recent Energy and Information Administration data, there was a pretty big spike in canola usage for renewable diesel in December versus soybean oil. So it is eating up a little bit more and more of that pie. It's not a huge chunk yet. I think it's about 16% of U.S. renewable diesel is made of canola at this point. But certainly, anytime there's a huge price drop, the fear is that it eats into soybean oil's competitiveness and in being made into biofuels.
Great. I think that's all the questions we have in now. I want to thank everybody for joining the webinar today. And again, you see Rhett's email up there. Send him a note if you have any other questions. And to see, again, Mitch Miller's blog, as well as the other blogs and up-to-date market information that we have, you can find that on the dtnpf.com website. Has some of that stuff on it. And of course, our customers at MyDTN and GrainsPro and our satellite customers can access that and even more through those subscription services. Thank everybody for participating today. And I'll remind you that this was recorded, and a rebroadcast link will be up on the dtn.com website within 2 business days. You can find that in the events section at dtn.com. That's where you registered for this webinar. As Rhett said, we've got 2 things coming up. Our next webinar is the March 31 grain stocks and prospective plantings report. Easy for me to say. That's going to be an interesting one this year, given what's going on in the marketplace and the difference between corn and soybean ratios, and where we think that, or where USDA thinks that farmers will be placing their bets in terms of those. The next WASDE webinar, as Rhett said, is April the 10th, and that'll be similar to this one. We'll have information up on the sites right after 11 o'clock, and we'll have the follow-up webinar at 12:30 Central Time then. And again, you can register for that at the dtn.com events site where you registered for this one. I want to thank everybody for participating. I hope you're having some warm weather. We've got some warm fronts going through. We got a little more cold weather. I don't think winter is quite done with us yet as spring approaches, but hope everybody has a great week. And for those farmers out there, I hope the planters are greased up and ready to go, because I think we're going to have some interesting planting conditions here pretty quickly. Thank you all again. This concludes today's event.